Assalamualaikum and a very good day to everyone. For now, our group want to make a sharing session about the article entitled The Rise and Fall of Management Accounting. Before that, my group consists of me, Khairul, Ikhwan Daniel, Husnul Hakim and Ifan Nabiha. As we know, management accounting basically driven accordingly by the cycles and procedures of the financial reporting, so that management accounting information delivered too late, aggregated, and too distorted. More focusing on quarterly or annual target, accounting system too narrowly focused on the income figures, which this information cannot be used to measure the actual value based on economic value. Then, management accounting information will not assist operating managers to decide for reducing costs and improving productivity. While productivity decreasing, it also time wasting to prepare for such unhelpful report. The information was not timely and relevant enough. It also distracts key factors from being found. All organizations might have the best management accounting system that can reflect with the vigorous global competition, rapid progress in products and technologies, and wide fluctuation. So, timely and accurate information play a crucial part to assist the managers in making decisions. Management accounting communicate by two vital communications between the managers and their subordinate. The managers communicate the goals and the objective of the organizations. In return, all the subordinates give them information about the performance and production efficiencies. So, the manager and its subordinate must have sufficient knowledge and understanding about the system. So, any deficiency about the system can be overcome. The rapid growth in the advancement of the technology assists the organization to have an excellent management accounting, where the production process nowadays involve technologies, so that the recording and accessibility of the information is much easier. Costs for collecting, processing, analyzing, and reporting have been decreasing. Highly automated environment is all the organization to have better management accounting system, which all the information can be captured for subsequent analysis. It also helps a lot of industry to rise and enhance the development of a good management accounting system. Now all the information is more accurate, timely, and effective, especially to devise reporting and control system functions. Managers can have useful information to make economic decisions.
Luca Pacioli's description of the fundamentals of a well-functioning double-entry bookkeeping system over 500 years ago is the earliest known reference to accounting. However, the need for management accounting appears to be a recent development that dates to the 19th century. There were no tiers of management in place during the beginning of the 19th century, which meant that the owner/entrepreneur merely needed to increase the amount of money coming in from the firm to pay off their suppliers and buy raw materials. The crucial shift in demand for management accounting information was the conversion process. Measures were first developed by hierarchical organizations to monitor the effectiveness of turning labor and raw resources into completed goods. In order to improve profit-seeking operations in hierarchical businesses, management accounting was created. It created summary measurements with a conversion costs focus. The objective was to calculate the expenses and assess effectiveness. Midway through the 19th century, hierarchical organizations were made possible by technological advancements, which enhanced the management accounting system. It might organize the delivery of finished goods across a broad geographic region and the purchase of raw resources. It made it possible for the development of a decentralized system that provided the required logistics, distribution, and coordination functions. The push toward scientific management was consistent with further management accounting improvement. Frederick Taylor began this movement in 1880 with the intention of increasing the effectiveness and use of labor and resources. The price of the final items was calculated by adding the costs of labor and materials. These costs caused price fluctuations, which were reflected in the sale price. As a result, the cost was more closely related to replacement cost than to historical cost. Management accounting has reached its final stage of evolution. It happened in the beginning of the 20th century and was made to help various groups. The article states that DuPont Powder Company is the most well-known company connected to it. The company struggled to coordinate a variety of tasks, which led to difficult choices being made. Senior management thus created budgetary and operating initiatives to address the problems. The invention of return on investment served as the greatest illustration. ROI measure used now has been developed by management accounting by 1925. Several come to mind, including forecasting, standard costs, and cash budgeting. Unfortunately, it hasn't continued to advance since then to meet new problems. There were fewer incentives to do so and no notable advancements. Modern issues like skewed inventory and delays are a result of this.
This might be connected to the rising desire for public ownership and financial reporting audits. So long as the overall amount recorded was accurate, auditors liked conservative values and didn't care if the valuation was distorted. Another factor might be the early 20th century's lack of a separate parallel system for internal and external reporting. Another factor mentioned in the article was the high cost of data collection, which prevented firms from spending money on improving management accounting systems if external reporting was unaffected.
For the next part, academic lead astray. The article explains how academics were led astray in academic lead astray by placing too much emphasis on the simplification of corporate behavior, since financial accounting practices were significantly influenced by economics one product or one production process model of the company. Management accounting experts saw little benefit in the cost allocation that were imposed on organizations by those methods. Top executives who felt they could run the business by the numbers came to rule many organizations as management accounting systems lost their relevance and capacity to correctly represent an organization's operations and strategy. Early 20th century business owners like DuPont, General Motors, and General Electric were well versed in the technology behind their products and operations. The next part is accounting for caravans. We might speculate as to what types of circumstances led to the requirement for accounting data in the 15th century, when Luca Pacioli may have created the first accounting book. Without a doubt, Venetian merchants engaged in cross-border trade. Think about a group of Venetian capitalists who purchase goods created in the northern Italy and hire an expedition to sell them in India. Once the commodities have been exchanged hands in India, the traders return to Venice and bought tea, which they later sold. By deducting the cost of the caravan and the cost of buying the first load of products from the revenue earned from the sale of tea in Italy at the conclusion of the expedition, the accountant determined a profit to be split among the venture's investors. The last part is the innovation needed. Modern businesses have both opportunities and challenges, which are both visible, and organizations' operation and strategy may and should be supported by management accounting systems. Current technology might be used to construct systems that are radically different from those already in use. The issue is a lack of knowledge, but the growth of this knowledge might result through discussion and experimentation. The imaginative spirit that prevailed 100 years ago, that at the start of the scientific management movement, may be recaptured by inventive managers and academic researchers who are committed to create the new concept for constructing practical management accounting systems.
Assalamualaikum. Hi, my name is Ivana Bihabati. And my part to present is traditional versus current or modern management accounting. Okay, firstly, I will tell you all what is the meaning of management accounting. Management accounting is the process of preparing reports about business operations that help managers to make short-term and long-term decisions. It helps a business pursue its goals by identifying, measuring, analyzing, interpreting, and communicating information to managers. Okay, back to our topic. There are several differences between traditional and current management accounting. The most significant difference between both of them is its reporting speed and accuracy. In traditional management accounting, the main aim is to analyze, summarize, and record expenses, and companies were not seeking expense behavior drivers and fluctuations. In current management accounting, the aim is to record, summarize, and analyze expenses and analyze the expense behavior drivers and fluctuations. In the past, companies were not competing so closely, therefore they did not have to do such an in-depth analysis of their expenses. Companies are competing closely, and companies must know about expense drivers to control them according to the results. Modern management accounting allows companies to record their expenses, break them down into different categories, and analyze them at every business or production stage. By achieving milestones, companies can easily stay on track with their expense drivers, align their expense with the external environment, and create a win-win situation by aligning their expense structure with their overall business strategy. Next, I will tell you all the reasons why current management accounting is more relevant as compared to the traditional management accounting. The current management accounting practices are typically different from the traditional management accounting, as they enable managers to make sound decisions to minimize costs, as well as in the same time add value to the products and services by improving the quality of products, which is required by the customers. In addition, the current management accounting systems allow organizations as whole to develop the innovative capacity of the organization and flexibility so that it can continually change and improve performance financially as well as its non-financial areas of performance. Moreover, under traditional management accounting, there are numerous opportunities to manipulate because the expense was directly recorded to the account when the products were sold. Therefore, managers were able to manipulate the production process in pursuit of bonuses. In contrast, under current management accounting, manipulations are almost impossible because expenses are debited directly to the relevant accounts at the time of occurrence, resulting in less opportunity for misrepresentation. Next, there are 4 stages of evaluation management accounting. For the stage 1, prior to 1950, focus on cost determination and financial control. For the stage 2, 1950 until 1964, focus on provision of information for management planning and control. For the stage 3, 1965 until 1984, focus on reduction of risk in business resources. Lastly, stage 4, 1985 onwards, focus on creation of value through effective resources use. To conclude, the modern management accounting relevant to modern organizational management issues as well rectify and reform the traditional management accounting practices to make decisions and specialized decisions based on relevant financial and non-financial information depending on the nature of activities, size, external circumstances, and market conditions. That's all for me. Thank you. Bye.
My group choose Toyota Corporation because Toyota, the further my group pick, is the one of the world leading automakers that producing over 10 million automobiles every year. My group are identifying Toyota using 3 methods that apply new management accounting approaches, which is TQM, JIT, and Kaizen posting. In this video, we will focus on one of the new management accounting, which is Total Quality Management of TQM of Toyota. Toyota Motor Corporation is a Japanese automobile company that manufactures and sells automobiles all over the world. Toyota automobiles are well known for their exceptional quality and endurance, allowing the firm to maintain continuously high earnings. This is most likely due to the company usage of TQM procedure, which were established in the 20th century. The use of TQM has also helped Toyota to build and construct the Toyota Production System, TPS, which has been utilized by many other companies in the manufacturing industry due to its benefits. Toyota Corporation use of the total quality management in order to improve the company's entire performance and operations. TQM entails applying quality management standard to all aspects of the company and demonstrating how Toyota control quality in all organizational management systems with the focus on the manufacturing quality. In order to implementing 2KM, Toyota Corporation has focused on increasing management authority beyond immediately services and goods, examine how customers use the product generated, allowing the corporation to innovate and enhance their communities, and they are concentrated on Kaizen to ensure that all procedures are quantifiability, repeatability, and transparency. Example number 1, the managerial system in Toyota. Toyota production and operation management system is similar as the managerial system. The capacity of the business to accomplish the TQA implementation goals and objectives is significantly impacted by the production and operation manager due to the vast scope of their responsibility. Example number 2, Toyota production system is a Toyota operational process and management system. During the processing, the TPS approach focusing on decreasing complexity through the use of the small and simple gear that is elastic and full-bodied. Example number 3, TQM implementation is dependability. Toyota has implemented a just-in-time production system, which is made up of a multi-skilled individuals and operate in teams. Compound controls enable the worker to deliver goods and services on site. To increasing the value and the efficiency appears to be the source of the concern for the Toyota administrative, mechanical specialists, and other human resources. And now we will see the challenges of implementation TQM in Toyota. There are some challenges in Toyota Corporation while implementing TQM, which is executive and quality manager are encounter several difficulty. TQM adoption cannot be successful in any business without appropriate implementation resources, including financial and human resource. The financial and human resources have evolved into the foundation of how projects and programs are implemented in the business. The TQM method drives organizational performance from all types to assure profitability and productivity. The conclusion of the Toyota Corporation, which is total quality management, is a concept used in the automobile industry, particularly by Toyota. As a part of Toyota, the concept explains how the company may generate value for its customer and other stakeholders. These improvements have been made possible in the part by the constant correction of the process flow. The essential role the information flow the management have been played in enabling TQM effort to be implemented, particularly through the continuous learning and team working culture, is of a particular relevance. That's all.